Hello, Courage.
Hello.
You've kept us waiting.
Please, sorry about that. Please, good evening.
Yeah,
Um,
good evening. Yes, go
okay,
ahead.
please. Thank you all for joining today's sections. We like to proceed, but before that, today happens to be the last session for our 4 weeks boots camp. And before we commence by tackling today's topic for discussion, um, we like all to revise by talking about what we've learned so far from the first section to till today's session, please. Randomly, if anyone could just unmute him or herself just to take us through what the person has learned from the first session to now. Hello, hello, Kojo.
Hello. Yeah, thank you very
Yeah,
much. Yeah, so over the past 4 weeks, this happened to be the last Wednesday or the last week for the bootcamp session. We've learned a lot about virtual blockchain fundamentals and the anti-money laundering implications for digital assets, where we looked at blockchain architecture, wallets, what private keys are, transactions, what goes into it. The We also learned about exchanges, the the VASP, what we call the virtual asset service provider, and what FATF also talks about, financial crimes. We've learned about the examples and what goes into the anti-money laundering, talking about the processes it goes through, the layering and all the other stuff. So far, it's been a wonderful journey here. Yes.
thank you very much, Kojo. Um, Anyone else to share what he or she learned through from the first session to till now, please? Rachel, can you help us with something?
Hello, good evening.
Good evening.
Okay, so as Kojo said earlier, okay, so we've learned about what virtual assets are. We know what cryptocurrencies are, and also we've learned about the keys, which we have the private and the public keys, and also hello,
Hello, please, we're listening.
please can you hear me?
Yes, we can.
Okay, so these are the things I've picked so far, and also we've learned about what these are menacing. Okay, so we've learned about what money laundering is, and also some of the red flags that shows terrorism and also money laundering. Yes, so we've learned a lot so far.
Thank you very much. Everything shows clearly we all learned something from our previous sections. Today we'll be having another interactive and an exciting yet very educative section. So, without wasting my time, um, Mr. Akwesi Jebi would be taking us through today's section. Um, if Mr. Akwesi is here with us, he can kindly have the floor to take us through. Thank you.
All right, thank you very much, Courage. And I guess everybody is doing well. And we are grateful for another day. And as Courage said, today will be the last day for our symposium. And I believe we will not stop there. We'll keep on learning till we get to understand crypto or digital assets very well. Now, we are about to begin, but then before I do, please hold on so I share my screen.
Nothing yet, but it's still got a few more hours to go. Or maybe something. See?
Okay. Can you please show behind if you can see my screen? Thank you very much. Thank you very much. So today we'll be looking at digital assets, risk assessment, and governance. But before I do, quick one. Let me find out from each and every one of us. I believe we all have knowledge about crypto, but today we are not just learning crypto, we are learning how to control risk that comes with it. And I'll take that again. We are not just learning crypto, we are learning how to control the risk that comes with it. So at the end, please give me a minute. I'm having challenges with my slides. I'll get back to you soon.
Quincy, please, is everything okay?
Well, everything is fine. I was just having challenges with my slides. So as I said, by the end of this section, participants should be able to understand customer, product, geographic, and channel risk factors. Again, you should be able to know how to integrate crypto exposure into enterprise-wide risk assessment. Also, we should know government's responsibilities, that is board versus compliance versus operations. We will also have a mock crypto risk scoring exercise. And then we will also learn how to link digital assets oversight to evolving African regulatory expectations. Okay, so that brings us to what are digital assets? What are digital assets? So digital assets are anything that exists in a digital or electronic form and has value, ownership, or utility. So if assets are electronic and exist in a form that has value or ownership, it is termed digital assets. An example of these digital assets are cryptocurrencies that are Bitcoin, Ethereum, stable coins that are USDT, USDC, tokens which are utility or security, and NFTs. Now, somebody will ask, what is the difference between cryptocurrencies and stable coins? Now, cryptocurrencies are such that, as we all know, and as we were taught before, cryptocurrencies are volatile. That means with time and with effect from the market, it can either appreciate or depreciate. That's why we say cryptocurrencies are volatile. And stable coins are coins that do not change in value. Take, for instance, the USDT. If you have one USDT in your wallet and it doesn't change with time, it is still one USDT. So it doesn't increase, it doesn't decrease, you still have the same value. Now, somebody will ask, what are tokens? Now, tokens are in this form. Tokens are such that, take for instance, non-fungible tokens. Now, these are tokens that has to do with, take for instance, Rachel comes to borrow 200 cedis from myself, and then as I'm paying back, I give Rachel 50 cedis, 450 cedis notes, which is the same 200 cedis. Now I will ask, have I paid Rachel or not? Can somebody help me?
Yeah. So to answer that, I believe you have not. Stable coins.
No, I'm not talking about stable coins. I'm talking about tokens. So Kwaku, if Richard should borrow 200 CDs from me, and in turn I give her 50 CDs, 50 CDs in 450 CDs notes, have I paid Rachel or not?
Hello.
Yeah, I can hear you.
Yeah, so I think you've paid because it's in the same value.
It's in the same value. So in turn, I have paid Rachel. So take for instance, this NFTs, as I was saying, can be in the form of paintings, music collections, art. So if she gets these tokens, Rachel gives me a gold pendant with her name inscribed on it, and I keep it for 2 days, and I return the gold pendant to Rachel with her name not inscribed on it. Have I given her gold pendant back? Can somebody help me out?
No, because I think there is a change in value with regards to what she gave is not what she's receiving.
Exactly that point. That's the difference between them. That's the Now I'll go to why assets create risk. Why assets create risk. Please, if you have any questions or you don't understand anything, please you ask before I proceed. So can I go on? Okay, Kojo. Okay. So I'll go on with why digital assets create risk. Why digital assets create risk. I would say for a fact that crypto is fast, and again, it is anonymous and irreversible, and I guess that's the main reason why criminals like it. Take for example, fraudsters receive money, move it across 5 different wallets, and it's definitely impossible to reverse it. So why digital assets create risk? One is fast cross-border transfer. As I said, crypto is fast, and then if you want to transfer money from here to China, and it will be in a space of 1 minute, second, and it's gone. Pseudonymous identities is another reason why digital assets create risk. And I guess with our intro to blockchain, with Kwakudi as our facilitator, mentioned all of these. And again, irreversible transactions done in crypto are irreversible, because when the moment you apply your digital signature, the transaction is done, and there is no way you can reverse it. Again, real life example of these cases: fraudsters receive funds, as I said, and move it across 5 wallets within minutes. That will take me to risk management framework. risk management framework. Now, somebody might ask, what is risk management framework? We assess risks from 4 angles. That is the customer, the product, the location, and the channel. I take it again. We assess risk from 4 angles. That is the customer, the product, the location, and the channel. Now, with risk management framework, when an institution wants to build this framework, the institution would first have to identify the risk, identify what kind of risk it is, assess the risk. How will this risk affect us? How will it cause the business? How will it cause the establishment? And you mitigate the risk. How mitigation is kind of how you're going to control the risk. Are you with me, please?
Yes, sir.
Okay, so I'll take it again. So the risk management framework, institutions would have to identify the risk, know what risk it is. Going forward, they would have to assess the risk, know how the risk affect the company, know how the risk will cause the company. Going forward, they'll mitigate the risk, how they can control the risk. And again, they will monitor the risk. So up to this point, if you have any question, you can ask. If I can go on, you can give me a thumbs up. Very well. Thank you very much. So we now look at the 4 risk pillars. We have the customer risk, as I said, the product risk, the geographical risk, and the channel risk. I'll take that again. You have the customer risk, the product risk, the channel risk, and the geographical risk. So in the next slide, we will look at the explanation for these 4 risks. And we'll start with customer risk. Customer risk. I know most of you have been with us since the inception of this symposium and can help us with what KYC is. Is there anybody? Rachel, please help us with what KYC is.
Okay, so please is know your customer, please.
Know your customer. Yes. So the customer risk is such that you have to know who you are dealing with, the source of fund, and the behavior. Take for example, you own a platform, you own an exchange platform, and then a student hops onto the platform and registers as such that he or she is a student. And before you realize, the student is moving $20,000, $15,000, $10,000. This very customer, this is a customer risk, and Can you hear me, please? Okay, so this is the customer risk and the KYC and the source of funds. The source of funds who let you know whether the customer on your platform is of a higher risk or a medium risk or a lower risk. Again, we look at the product risk. Product risk is such that, say, a platform releases or a company releases a token or a digital asset. The company will have to check if the said token or the said asset will be of a higher risk. If somebody will want to send that token or digital asset from one country to the another, whether that the token will be of a higher risk or a lower risk. Say the product can be of risk. I don't know if you get me.
Please take that
Can you
again.
come again?
Okay, I'll take that again. So the product risk is in this form. Is it when establishments brings out tokens and okay, Philip.
Yeah, okay, please, sorry to take you back. So
Very
for
well.
the customer risk, I wanted to know if a customer gets on board as just as the scenario you were given as a student, and after some time you see that the customer, this student or customer, is moving funds which are more than the expected. So as you indicated, a student moving funds $150,000, $20,000, and all that. What will be done about it? Is it that it's going to be the customer is going to be frozen, his or her account will be frozen, or what will happen to such a customer? Or the customer will be reprofiled? Is there anything like that?
Okay, so Philip, I got your question, and the customer is simply asking who is this person, and can we trust where the money is from? Do you get it? So immediately, I guess we'll get to that in the course of the section, and if you can hold on, I guess I'll answer your question with time.
All right, sure, thank you.
Okay, so I'll take it from Rachel then.
Okay, so sorry. So please, I wanted to come in at the question that Philip was asking. So according to my own research, according to what I've read about KYC, they said for a new person, right, to enter into maybe the traditional banking system or any other places that revolves with virtual asset service providers. So if a person wants to join maybe an institution to do an investment or something, it is the responsibilities of the people that are there, like it is the responsibilities of the staff to do a background check on the person. So that background check, there are certain people that you might request for information from them, but they may be hesitating not to tell you actually what is about them. So they have to go alongside to do a secret background check on the person who wants to invest or who wants to work with them. So actually, that is my idea about the KYC thing. Please, thank you.
All right, thank you very much, Rachel. And to add to that, I think KYC is part of the requirements if you want to jump on any exchange platform or you want to do any transactions related to traditional and digital banking. So can I go on?
Please, before you go on, you've not answered my not really a question though. I'm asking you to share more light on the product risk, but I'm not sure if I heard you talked about it and how privacy coin, because I saw privacy coin there, and how is it um, a risk product?
Okay. So, okay, can I help? Yes. So to answer your question, to help with your question, I think for privacy coins, example, we have what we call the Monero and the Zcash. These coins prioritize user anonymity, like they make sure that, like you said, you will talk about the theft travel rule, but then Monero and Zcash are examples of privacy coin, and they prioritize anonymity of its users and transactional confidentiality using advanced cryptography, making them ideal for private and non-transparent transactions. I don't know if you get my point. So, as against stable coins, what they do is they peg their currency to fiat, or let me say a currency. So it could be e-Naira to Naira or the e-cash to cash, right? To minimize volatility, which is common in blockchain transactions. So these stablecoins offer stability in terms of volatility. And I remember you asked a question about what happens afterwards. So like he mentioned earlier about the KYC and another thing. Can you go back so that you can aid me in my explanation?
Okay.
Yeah. Yes. The customer risks.
Okay. Let
one has to do with the source of funds. Yes.
Let me also chip in. Let me also chip in here. He was asking about the privacy coins, right?
Yeah, and I think the question has doubled now. Yeah. So to conclude, I want to say that as an exchange or a virtual asset and service provider, what you can do in this case, once you done your KYC, you know where the customer is and all that, you also have to know the source of funds. So he mentioned a student. So a student transacting a $15 transaction is quite suspicious. So what you do is you file what we call a suspicious activity report with your financial institutions or the regulators. So in the case of Ghana, you can file it with the what we call the Security and Exchange Commission. So that's it. I hope that answers your question for you.
Okay,
Mr. Philip, is your question answered?
Yeah, it answered it kind of, right?
Hello, I didn't get that clear, please. Sorry.
Yeah, but that will lead me to another question. But I don't know if I should leave it till the end of the presentation so that we won't use question and answer to obstruct the flow of the presentation. Is that fine? So we can continue the presentation.
Would you like me to talk about the privacy coins? Like the Monero, he said, these are designed to hide the sender, the receiver, and the amount. So it is privacy focused. So such coins are high risk. Am I clear?
Yeah, I understand they are high risks. Now, are you saying in the course of sending or receiving, it doesn't have a digital footprint? And I understand they said whatever has the digital footprint can be traced. So how can you reconcile that? right? And again, are you saying if I register with an exchange, right, and I want to, transacting Monero, right? Are you saying I can hide my identity even after registering with the exchange, or I'll be allowed to trade on that privacy coin without registering, um, without undergoing through a KYC with an exchange? I don't know if you understand my question.
Can you take it again?
Okay, now Zcash, Monero, they are private coin, right? And for you to transact, probably you have to register with an exchange where you've been onboarded, you do your KYC and the likes. So I saying if I'm transacting Monero and Zcash, even with my KYC being registered before onboarded, I can still not be traced. Or in the course of me onboarding, there is ABC that can be hidden that will prevent the law enforcement to not to trace my transaction.
Okay, so let me come in here. Philip, thank you for your question. So apparently, Cash, Monero, those are privacy coins, and they are isolated. They're on their own. It's an asset. It's a cryptocurrency asset. So bringing it to the exchange scenario you're talking about now, it means for you to be able to trade any cryptocurrency on an exchange, it means there's liquidity there. It means the exchange has listed it. It means the exchange has allowed their customers to trade with it. So if an exchange has not listed privacy coin, Monero, Zcash, and Co, you cannot go there to trade it. It's not possible. So now bringing it back to the risk assessment. So when you're doing your, let's say, counterparty due diligence on maybe an exchange or a VASP, and you inquire from there, maybe from the questionnaire, do you, like a question like this, do you trade privacy coins, or do you have privacy coin listed on your exchange? And the customer says yes, or the counterparty you're trying to work with says yes, or the VASP says yes. That shows you that that exchange or that platform is already high risk, because they have allowed they have listed itself on the exchange. So because of the high obfuscation techniques that these exchange or these assets have, what the regulators are saying is not to trade these privacy coins, or not to allow the trading, or not to list it. So that's the regulatory factor there. For instance, there was a time Binance was trading Monero, but it got delisted over time, right? So you could count the exchanges or the platform that have privacy coins on their platform. So that's how that product. So anybody that has maybe built any product around a privacy coin, that should tell you that whatever the person is doing is high risk for you, and it's not left for you as maybe the exchange or the business to decide if you want to deal with this particular counterpart or not. Coming to that of customer profile. So when you profile a student as a student, okay, what is your source of fund in the initial onboarding? And he or she says, I'm a student, and you have an idea of how the customer should behave on your platform. And suddenly there's a particular behavior that goes against what you have profiled. So as a compliance officer, what you need to do is to ask questions. And you ask relevant questions. Where is the source of this fund? What happened? Did you get a raise? Did you sell a land? And maybe they will say, oh, my parents gave me this, and they're able to defend it. So you've cleared that, right? You've cleared that, oh, this fund came from maybe sales of assets. You have the person submits the document to back it, and you're able to confirm that, okay, this is maybe something that just happened one time. And then you check again, have this student maybe graduated, is he now doing business, that he's now getting salary? And if that is the case, it could call for a profile upgrade. You could upgrade the person's profile. The person submits the necessary documents, you upgrade the profile, and that is clear. But whereby the person does not check these boxes out, you were not able to confirm that this was actually a very licit transaction, not illicit now, a very good transaction, that it is not illicit, and you were not able to confirm that, then you go ahead and file suspicious activity to your financial intelligence unit. So if it is Nigeria, it is NFIU, and if it is Ghana, it's FCA. All right. So I don't know if that's clear, Philip.
Yeah, that's very clear. Thank you very much.
You're welcome. Apache, you can
Yeah,
go ahead.
thank you. Yes, thank you.
Thank you very much, Shoma, for that one. And so we go on with the geographical risk, and under the geographical risk we have high risk jurisdictions. Now, when we talk about high risk jurisdictions, there are jurisdictions that are of weak or inconsistent regulation or exchanges and custodians. They also have poor enforcement of financial law, political instability, or sudden policy shifts. Now, again, this under geographical risks, we have what we will call weak AML controls, which are the anti-money laundering controls. So these are places where the anti-money laundering controls are not effective there. Regulators are not regulators, or I would say regulations are not quite effective there. So when you transact businesses in such areas, that's what we term as geographical risk. Can I move on? Yeah, I can move on. Please give me a thumbs up. Now I'll move on to channel risk. Now, with channel risk, under the channel risk, we have what we call the mobile app and the web, or the VPN. So I would like to ask, if you do a transaction on a mobile app and on the web, which is safer and why? Can anybody answer that, please?
Hello.
Kojo, I'm here.
So I would prefer the mobile app on the basis to the web, on the basis that most of the websites are cloned, and these mobile apps are once developed by the said companies, maybe like GCB having its own GCB banking app. And normally when you go to the site, they have a cloned one. Just like what we are experiencing in Ghana currently. When you try to order food from Chicken Man, Pizza Man, you might end up paying to somebody if you are using the website.
Okay. Thank you very much, Kojo. Anybody else?
Yeah, so I think I side with Kujo in the sense that so both mobile app and web platforms for crypto transaction have unique security advantages and risks. But then for mobile apps, they are generally considered safer for transactions in the sense that if you use a mobile app like the Trust Wallet or the Binance app, some of them requires biometric access, unlike the web applications where you just have to go in and input your user ID and password. Though some may have some form of MFAs, but then I believe the mobile apps are generally considered safer than the web platforms.
Okay, so with that being said, do we have an idea about what the channel risk is now? If you do, please give a thumbs up. I cannot see. I only saw Rachel and Koju and Koku. What about the rest? Is there anything we don't understand? So I can move on now. If I can move on, please give me a thumbs up. Okay, so now it brings us to what we call the risk scoring model. The risk scoring model is a combination of all the pillars. Take, for example, product risk. The product risk is either low, high, or medium. So say the product risk is high, and they are sending it. We are sending the tokens or the crypto to a country like Iran, which is also of a higher risk, and the channel that we used, the wallet that is being used today is seen in Ghana, tomorrow is seen in Iran, tomorrow it is seen in another country, tomorrow it is seen there. If such is the case, the channel is also of a higher risk. So in this case, if you should combine all the risk, we are scoring the model. If we are doing a risk scoring model, with what I've said, we will term it as a medium, a low, or a high, a higher risk. Or let me put it this way: as a compliance specialist, if you see the aforementioned, what I just mentioned, when you are doing your risk scoring model, will you term it your risk as a lower, a medium, or a higher risk?
Can you give us the parameters you are looking at?
Okay, so we looked at product risk, geographical risk, and the customer risk. And I was saying that when we take the product risk, say the product is not of a high risk, it's of a medium risk, and the same product is being transferred from, say, Ghana to Iran, which is the geographic location where the transaction was sent to. So Iran, we all know, is a flagged country when it comes to crypto. And then look at the channel risk, the wallet that was used to send the said tokens or the said crypto. Today, if when we are tracing, we happen to see it in different locations at different times. So will you tell, when you're doing your risk scoring model, considering the product risk, the geographical risk, the channel risk, and the customer risk, will you term your assessment as a higher or a medium risk?
Okay, so for me, I think it should be a high risk transaction. Considering the location, Iran, as it's a flagged country, and also it's being the crypto or the token seen at a lot of places at the same time. But I think one of the parameters was that one transaction, a token is moved between platforms or to different locations at a short period. So with this, or we're considering all these things, it will be flagged as high per my assessment.
All right, thank you very much, Philip. Does anybody agree with him? Thank you very much. So we move on to what we call the enhanced due diligence. The enhanced due diligence. For high risk users, for people who or customers who we know are of a higher risk, I would say, who are of a threat to companies and establishments. The extra due diligence that is done on them is the source of their wealth verification. The source of their wealth verification. Take for instance, as I said, a customer in Iran doing transactions, moving crypto from this side of the world or that side of the world to this side of the world, and you feel the customer is of higher risk. The extra due diligence, what you have to go on further as a compliance specialist to look out for is the source of their wealth verification. You have to know what kind of work they do to keep such money in their wallets or in their accounts. Now, transaction review. Transaction review is just like after they have done their transactions, you go over and check on your transactions, where they send their transactions to, who they sent them to, where they sent them to, and all that. And again, you also do ongoing monitoring. You make sure that said wallet will be on guard to check that wallet. Is there any question, please? All right. So we move on to the enterprise-wide risk assessment. We move on to the enterprise-wide risk assessment. Now, somebody may ask, what is the enterprise-wide risk assessment? Now, enterprise-wide risk assessment is the identification, assessment, monitoring, and managing of all risk across the entire business, including operational, financial, regulatory, technological, and reputational risk. I'll take that again. The enterprise risk is the identification, assessment, monitoring, and managing all risk across the entire business, including operational, financial, regulatory, technological, and reputational risk. This means that it will have to cut across. It will have to cut across, be it identifying the risk, assessment, assessing the risk, monitoring the risk, and the management of all risk across the entire business. That is operational. How the business operated, how finances are moved, how regulators are checking the system, how the technologies are working, and again, what risk it brings to the said business's reputation. So under these, you'd have to aggregate all crypto-related risk. Again, you have to score each risk. As I said, as we said earlier, between the three models, the low, the medium, or high, you have to check if those risks are something you have to not keep your eyes away from, or something you can let go, which is lower, or a medium, or a high. You again have to design mitigation controls. Designing mitigation control is basically devising ways to arrest those risks and to manage those risks. That brings us to governance structure. Governance structure. In every establishment, in every establishment we have the board, we have the compliance, and we have the operations. The board would have to set risk appetite. If I say set risk appetite, I mean make sure they do away with all risk, and the compliance will have to control and monitor that risks are controlled or managed or monitored. They will monitor incoming risks to make sure no risk is taking them by surprise, and they will also have to control it and manage the risk, and the operations would have to do the execution. Okay, so that brings us to the last slide, which is the regulation and the FATF rule. And the Financial Action Task Force is the global watchdog for financial crimes and CFT, counter finance terrorism, and they have 40 recommendations. 40 recommendations, and under the 40 recommendations, the recommendation 16 talks about what we can see, what we see here, which is the FATF travel rule, which requires that the sender and the receiver are each provide their information, that is their KYC. So the Financial Action Task Force has made sure that anybody transacting huge amounts from one location to the other, the sender would have to provide their KYC, that's their information, and the receiver will also have to provide their information. So we know who is receiving and who is sending. Okay, so with all that I have mentioned before, we've learned from the start of this symposium, I guess now we all know that A&D Forensics, it's a blockchain intelligence and a financial crime compliance firm supporting institutions across Africa and navigating evolving digital assets risk. A&D works with banks, fintechs, regulators, virtual asset service providers to strengthen compliance systems and improve financial crime detection. It means when we talk about financial crime policing, you can't do without mentioning A&D. And our core services are AML and CFT training, practical regulator aligned training for compliance teams, independent AML audit risk-based reviews of AML frameworks, controls and reporting system, small contract audits, identifying vulnerabilities in blockchain-based applications, blockchain forensics and investigation, tracing transaction, identifying illicit flows and supporting enforcement. So if you join this session today and you want to really know more about the above services, you'd have to contact A&D. And I believe this is the best place to know everything crypto related, AML and CFT related. Thank you very much. So I guess now I'll be open for any questions and contributions. Kojo.
Yeah, thank you very much. So I would want to know, is it as part of the presentation, you made mention of why crypto is something these people criminals actually love to use it because of um its fastness in transfer and the pseudonymity. And I would want to know because almost everybody using crypto knows that it's because of the pseudonymity of it and also its fastness and the charges are less. That's the reason why they are using. So at this point in time that Fatef is talking about the KYC and a whole lot of we knowing who is sending and who is receiving, isn't it going to actually bring down or reduce transactions and also patronage of cryptocurrency? Thank you very much.
Okay, Kojo. If I got your question right, you're asking about uh can you take it again?
So I'm coming from the point where we all know that people are actually into crypto or they love using crypto because it is fast in transfer. One, two, it's anonymous, especially when you send. There's nothing like KYC for you to know the receiver and the sender. And I'm asking that now that FATF is in with these regulations and so on and so forth, isn't this going to reduce the patronage of crypto? Isn't it going to actually kill crypto because people were using it because of that system, and now you are bringing in regulation to let them know where this money is going. Like you want to know what they are doing, something they didn't want people to know, hence using crypto.
All right, Kojo. I think I have I understand the question now, and I believe such 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 uh, such recommendations and such regulations will not kill crypto, but it will change who uses it and how they use it. Now, these regulations are put in place not to deter people from using crypto, but to deter bad actors and criminals from using crypto. So this is to make the right people use crypto the right way and for the right purposes, rather than making bad actors use crypto to finance crime, to finance terrorism, and all that. I don't know if I've answered your question. Very well, Kojo. Thank you. Any question? And Kojo, again, to add to that, the Financial Action Task Force push on KYC and the travel rules to make the platform knows who is sending, who is receiving, and share that data between institutions. And if this is not enough to make crypto secure for anybody, I don't know what else will.
Okay. Please. Can I ask a question? Okay.
Philip, go on. I'm all ears.
All right. Sure. So realized per the KYC criteria and all that. At a point, whichever category you are, as per your onboarding stage, whether a student, a trader, or something, at a point in time, or a particular transaction can be flagged. Is it that there are thresholds for each category of people, such that I would know that, okay, if I'm a student and I send $20,000, it will be flagged as a suspicious account, which needs more investigation or documentation. So that I'm asking this so that we also know that if someone who is aware of these arrangements or classifications would also break transactions, so people will be sending the limit 5,000, 5,000, 5,000, or otherwise something like that of that sort, just to circumvent the documentation and other processes which comes with it when a bigger transaction is done.
All right, Philip, thank you very much. Philip, what we should understand is that you asked about how do you call it? Somebody suspicious transaction report, right? So that is what do you call it? The work of compliance officers. It's the work of compliance officers to check on every transaction and to know where the transaction is going, where the transaction is coming from. So yes, a 20,000 transfer from someone with no prior activity or income profile will likely get flagged. Not because you're a student, but because the behavior does not match the profile. Do you get me, Philip?
Yeah, I get it. But you see, I'm trying to ask if is it the arrangement of the platform or the arrangement of the institution using the platform. That's where I'm coming from. So that you know that maybe institution A
Okay,
has a
Philip.
risk appetite of,
Philip,
let's say, yeah.
Regulators have regulatory reporting thresholds.
Please, I didn't get that. Please, can you come again?
Some regulators have regulatory reporting thresholds. They have thresholds.
Yeah.
I can see Thomas and
Okay, well done, Akwasi. Thank you, Philip, for that question. So for transaction monitoring, it is not just the transaction volume you are checking, right? A customer can do a transaction of even $2 or maybe 10 CDs, as the case may be, whatever it is, as little as even 1 CD, and yet you find suspicious transaction on top of that customer, right? So it's not just the volume that we're checking. We're checking the source of that fund, right? So if the funds are coming from, let's say, darknet market, or a reported wallet that has been involved with scams or hacks or fraud, it can make the compliance officer to flag that transaction, especially if you have automated systems. So we use tools for these things, right? When it comes to reporting of volumes, for instance, you know, we might have what we call current transaction reporting that applies to the fiat, right? For instance, in Nigeria, we file current transaction reporting above particular threshold to the CBN, and of course the BOG also does that. That one is different, right? So a suspicious activity, behavior, those are the things that would accumulate to determining what you should do with that customer. And you are also supposed to know your risk appetite. All these things are supposed to be documented, and by the time you see it, you would already know what to do based on what you people have, your risk tolerance, your risk appetite of your institution. So one thing I would like to explain to you is that you can't get these things done with your eyes, right? You need to have tools. We have what we call blockchain analytic tools. For instance, Chainalysis offers the Reactor, KYT. Also, we have Clue from BIG, either Clue or BitRank, Clue and BitRank from BIG, and other solution providers. So the essence is that these tools combine not just behavior, some will also give you behavior, and then the source of funds, and then where the wallets have interacted with before. So you might be asking, how will you know? Why should it bother you? Now, crypto works in such a way that if you have $100 in your wallet, and that $100 you've been using it, you got it from somewhere good, and it was okay, nothing, no issues, and you did a transaction, or somebody sent money to you, and it happened that the money that was sent to you was $1, and it came directly from maybe darknet market, or from scam, or from fraud, and it's $1. Because you have received that $1, your $100 is now tainted, right? Automatically, that wallet that you have allowed to send $1 into your wallet has made you high risk, because it's a direct counterparty, right? It's very direct. Had it been, let's say, the $1 went to Akwasi, from Akwasi's wallet, it went to Boateng's wallet, from Boateng's wallet, it went to my wallet, from my wallet, it went to Philip's wallet, then it came down to your wallet. Yes, it's still got to you, but it's no longer direct, it's indirect. And the risk, by the time it's getting to you, by the time the hops are elongated, the risk will reduce, right? So probably in your own risk appetite, you will see on your own risk profile, you see that, okay, this has gone like 4 hops or 5 hops away. We could maybe allow it. But because the other instance that I gave was very direct, is high risk, is critical, you shouldn't allow it. So you, as a compliance officer or a platform or an entity, you're supposed to have tools in place to help you prevent these funds from getting into your wallet. Because once they get into your wallet, they taint your wallet, they increase the risk score of your wallet and probably your entity. So other entities will be preventing or be dodging to have transactions with you. Some of us might have had this experience of, oh, you want to make transfers, especially, let's say Binance, for instance, you want to make transfers. You want to make transfer out of your wallet. You're trying to make transfer. Maybe you want to send money out or pay for something. And then they tell you that, hey, you see that wallet you want to send money to, will not allow you. You cannot. In fact, as a matter of fact, you just have to give us another wallet address, or you forget about sending out that money. Why? They've seen something. They've seen that where you're sending it to would taint their own wallet, right? So they would ask you to provide a clean wallet for you to send it to them, because they don't want issues. So that's like a scenario of how these things work. So it's not just about transaction volume that will make a particular customer's transaction suspicious. I don't know if that's clear, Philip.
Yeah, very clear. Thank you very much for the clarity.
You're welcome. Okay, so I think Courage, I think you can take it up. I don't know if I have another question, or does anybody still have a question?
Yes. Evening once again, Philip. Yeah.
Okay.
Yeah. Is a question slash clarification, right? Is there a way an exchange can screen a wallet address to know if the wallet address is fine or if it's fictitious before funds can be sent into it, or so yeah, or it can receive funds?
Did you say fictitious? I want to get that word. Like, I want to learn that new vocabulary.
Yes. I said
Fictitious.
fictitious, like if it's not genuine, right?
Okay,
Like
fictitious.
fake, yeah, fictitious, yeah, like a fake wallet address, or like a cloned wallet address, like
There's nothing like
you know.
a clone wallet address. Wallet address is wallet address. The only thing that you say is maybe, has that wallet transacted before? Or yeah, that's it. Is it a new address that was just created? But wallet address is wallet address. So yes,
Okay,
like
so,
I said before, like I said
so you're
before, yeah,
saying wallet address cannot be cloned, right? Cannot be duplicated.
it
I'm
doesn't
just
work that way.
curious. Mhm.
No, it doesn't. It doesn't work that way. Um,
Okay.
the only thing that is closer to what you're saying is what we call crypto address poisoning, and that is not even fake wallet address. It's actually, let's say a hacker has seen your wallet address. Of course, wallet address should be seen. It's not private. It's public. So a hacker has seen your wallet address and monitored the kind of transactions you do, saw that probably you usually send funds to a particular wallet address, and they have that intel, and they were able to, and they do that through is it clip jacking, like hijacking, like clip jacking, stuff like that. So, or crypto jacking, whatever it is. So when they get your clipboard and you copy, because normally, wallet addresses are very difficult to start typing out. In fact, it's not even advisable to start typing them out because you could miss the either one letter or one word or whatever the case may be. So by the time you copy your wallet address, you wouldn't know that the attacker had already probably changed the last 2 or 4 digits, what first 4 digits, all those kind of stuff. Just changed it, and then you might just scan through it and see that, oh, this is the wallet. Oh, it starts from OX. Oh, my own is this, and you do that transaction, and unfortunately, it didn't get to where you expected it to go to. It got to the attacker's wallet, right? So that's like crypto address poisoning. But you wouldn't say that's a fake or a fictitious wallet. It's a real wallet. It's somebody that's created it. It's someone that is in control of it. But the person has kind of used it against you. So back to your question, whether is there a way an exchange? Of course, that's what I mentioned earlier. As a compliance officer, you're going to be having tools, and these are the things that even during our trainings we show our students, right? Our students get to learn about these tools, practice with them, see how they work, integrate them into their platforms as well. Then you can automate them, right? Depending, of course, CBNI is talking about automation. So depending on how big or small your platform is, right? If you're having big transactions, of course you have to automate. But if you're still a startup, you can still manage fewer transactions. How you can be doing, because the tools come with UI UX. You can be doing the manual way. But once you're hitting it heavy, you go for the API, do the whole integration, do the automation properly. And once somebody is about to make transfers, or once funds are about to come into your platform, you automatically screen them, and based on the controls you've set in place, based on the rules you've set in place, what should happen when this is flagged, because you set your rules, you have your rule engine, no matter where you do your transaction monitoring. So if such cases happen, you review them, right? And once it's not false positive, you can now escalate it and probably file for suspicious activity if it was suspicious. If it is not, if it's not false positive, if it's true positive, that's when you file. But if it's false positive, you close it, right? And document. So that's like the normal process. But you need your tools and all. So all these things are like advanced trainings and hands-on trainings that we also teach about and help platforms to get used to. So I don't know if that answered your question.
Yes, it does. Thank you.
You're welcome. Okay, so do we have any other question? Courage, are you here?
I think Courage is having a meeting.
Oh, okay. So do you want to conclude, Martin?
Yeah. So
Okay.
Hey, please, is there any other question? Oh, okay. So if there is no other questions, I think we bring this bootcamp to an end. We thank you all for participating. It's been a month, 4 weeks of this bootcamp, and we are grateful to all of you for joining consistently. I've seen two Philips; they've been very consistent. We are grateful, and we hope to see you in our next training. A&D, we have our next cohort coming up. We hope you guys will be in touch and join our next cohort, which has to do with the 3CS Certified Crypto Compliance Specialist Program. We hope to see you. And there are also others that are coming on. We share our community link with you. Everything will be posted there. We are grateful to all of you for joining. Thank you very much.
Thank you too.
Okay.
Yeah,
Well,
it's like more. And feel free to actually follow us on social media, drop your comments about this bootcamp. We would love to hear from you. And also, I think we could share feedback form so that you could drop whatever it is you want to say, or you could feel free to also share your experience. In fact, I would love to hear from you. Philip Artui, are you in Accra or Kumasi?
I'm in Accra.
Accra. Okay.
Yeah.
Which bank?
First Bank.
Oh, nice. Okay, so it would be nice to connect with you as well.
All right, sure.
It would be nice to connect with you. So maybe you could drop your details later so that we could connect with you. Okay.
All right, sure.
All right. Thank you so much for joining, and thank you to the other Philip Lawrence. You were also very consistent. In fact, if we were to give award for people that were super consistent, I think you will carry that award. Thank you for being that consistent person and joining as well. Okay. Yeah. So please do well to keep following us, keep asking your questions, even in the community. All right. Thank you, everyone, and have a good night rest. Bye.
Thank you. We appreciate the opportunity. Thank you, everyone. Bye.
Bye.
Bye.